If you are over 50, you want to stick around till the end of today's conversation because I'll be giving you the top 10 tax deductions and credits for people over 50. We're going to have a conversation about the most popular tax breaks for older adults and retirees. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. And if you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to talk to you about the top 10 tax deductions and credits for people over 50. Now, we all know that retirement has a lot to offer, which explains why so many taxpayers thoroughly save for it over the course of their lifetimes, right? There are a lot of stuff you can do. There are a lot of perks that money really can't buy, like spending time with your grandchildren or just enjoying nature and the things you've been saving for example, travel, not going to work every day, or just sticking around and just chilling, right? Now, the IRS has a lot of perks, a lot of tax credits and deductions for people over 50. Let's get right into it. Number one, you have a larger standard deduction. So you don't have to pay taxes on as much as of your income because the IRS allows you to begin taking an additional standard deduction when you turn age 65. So for the tax year 2020, you can add an extra $1,650 to the standard deduction you are otherwise eligible for if you are single or you qualify as head of household. And you can add $1,300 for each spouse who is age 65 or older if you're married and file a joint return. Both of you don't have to have hit your 65th birthday either. And the thing here is that for the tax year 2021, which you file in 2022, this amount increased to $1,700 and $1,350 respectively. One thing I want to say here is that there is a big conversation to be had about the standard deduction versus itemized deduction, which is really better. As of tax year 2020, the tax return you will file in 2021, the base standard deductions before the bonus add-on for seniors are $24,800 for married taxpayers who file jointly, and qualifying widowers, $18,650 for heads of household, and $12,400 for single taxpayers and married taxpayers who file separately. So the thing here is that many older taxpayers may find that their standard deduction plus the extra standard deduction for age works out to be more than any itemized expenses that they can claim, particularly if their mortgages have been paid off, so they don't have that itemized interest deduction any longer. All right, so you have to kind of see what works for you. You have to see actually your situation and what really matters. But you could actually gain a larger deduction for itemizing if you still have a mortgage and factor in things like property taxes, medical bills, charitable donations, and any other deductible expenses that you might have. Tax deduction and credit number two, charitable deduction. Now, you have to understand that if you donated cash to qualified organizations during the previous year, you can itemize and deduct those contributions up to 60% of your AGI, your adjusted gross income. So when it comes to donated property, the cool thing here is that if you donate property other than cash, you can usually deduct the fair market value, the FMV, of those contributions from your prior year federal income tax return. And one thing I want to say here, and this is a big reminder: federal tax deductions for donations like cars and boats are generally limited to the proceeds from their sale by the charity itself. So this applies when the value you claim is $500 or more. One thing that's very important to mention as we talk about charitable deduction is that there's a concept called qualified charitable distributions. Retirees are typically required to withdraw money from traditional retirement accounts and pay the resulting income tax bill. However, if you don't need the money, you can avoid income tax on withdrawals from traditional retirement accounts if you make something called a qualified charitable distribution. So retirees ages 70 and half and older who transfer any amount up to 100,000 directly from their IRAs to their qualified charity will not owe income tax on the transaction. This is very important. I'm going to repeat it. Retirees ages 70 and half and older who transfer any amount up to 100,000 directly from their IRA, their individual retirement account, to a qualified charity will not owe income tax on the transaction. So this is one of the things. We have an entire show coming up on the qualified charitable donations, and this is a great strategy when it comes to estate planning, when it comes to fiscal management, when it comes to fiscal planning. The idea here is to make sure that you are transferring cash or stocks in your IRA into a charity that you love, into a cause that you espouse, and you have to do it in a certain way. As long as you meet the criteria that the IRS has put in place for those transactions, you do not have to pay income tax on any amount up to 100,000. Very important. After 100,000, then you have to pay taxes on the excess amount, on the extra amount. Deduction number 3, or credit number 3, you have tax credit for older adults. Now, one of the most significant tax breaks available to older adults is something called the TCE. So the tax credit for the elderly and disabled. And this tax credit can wipe out some, if not all, of your tax liability if you end up owing the IRS. So ranging between $3,750 and $7,500 in value, this is a credit that can be created for actually deleting your tax bill. Deleting. You must be age 65 or older as of the last day of the tax year to qualify. So that January 1st rule applies here too. Basically, when it comes to the age limits, so you are considered to be age 65 at the end of the tax year if you were born on the first day of the ensuing year. And you must be a U.S. citizen or a resident alien. But if you're non-resident alien, you might qualify if you're married to a U.S. citizen or a resident alien. Okay, you must file. To actually qualify for the TCE, you must file a joint married return with your spouse to claim the credit if you're married, unless you didn't live with your spouse at all during the tax year. And you will not be eligible for this credit if you earn more than the following. So we're going to put the numbers on the screen. So 17,500 or more, and your filing status is single, head of household, or qualifying widow or widower. $20,000 or more, and you are married but only one of you otherwise qualifies for the credit. $25,000 or more, and you file a joint married return. $12,500 or more, and you filed a separate married return, but you lived apart from your spouse all year. So these numbers are based on your adjusted gross income, your AGI, not your total income. Very important to mention. And your AGI, you get your AGI after taking certain deductions on the first page of your 1040, your Form 1040. And limits also apply to the non-taxable portions of your Social Security benefits, as well as to non-taxable portions of any pensions, annuities, or disability income you might have. And this is important. And we're going to put also the limits on the screen right now. So those limits are as follows. $5,000 or more, and your filing status is single, head of household, or qualifying widow or widower. $5,000 or more, and you are married but only one of you otherwise qualifies for the credit. $7,500 or more, and you file a joint married return. $3,750 or more, and you file a separate married return, but you leave the part from your spouse all year. Okay, so those are the limits for the Social Security benefits. Having said that, though, as tax credits for seniors go, the tax credit for the elderly or disabled offers one of the best opportunities to limit your taxes and keep more of your money. Deduction number 4, we have medical expenses. Very important. All right, so what is the deal here? Medical and dental are expenses that can be very high depending on your situation and your medical condition. And those costs often make up one of the biggest expenses for seniors and retirees, right? We all know that. And the cool thing here is, fortunately, many of those expenses may be tax deductible on your tax return when you file your 1040, including what you pay for health insurance premiums, long-term care insurance, prescription drugs, and more. So if you are 65 or older and you itemize your return, expenses ranging from hearing aids and wheelchairs to in-home nursing care and prescription supplements may be used to reduce your taxes once they exceed 7.5% of your AGI, your gross adjusted income. We have an entire show on how to calculate AGI, so you might want to actually check that out once it's out. So I'll give you an example. If your AGI amounted to 40,000, say during the previous year, all eligible healthcare costs paid beyond the first 3,000 can be deducted from your taxes, a potentially huge savings on this year's tax bill. And the 3,000 equals what? 40,000 times 7.5%. So depending on your income, tax situation, and cost, medical expenses may be one of those tax deductions for seniors you cannot afford to overlook before filing your return. And I also want to talk quickly about the HSA. So you also have, when it comes to, as we're talking about healthcare here, you also qualify for a higher HSA contribution limit. So workers with high deductible health plans can claim a tax deduction on contributions to a health savings account, HSA. All right. And the cool thing here is that distributions from those accounts are tax-free when used to pay for qualifying medical expenses. And individuals who are age 55, not 65, 55, 55. So individuals who are age 55 or older by the end of the tax year are eligible to contribute up to $4,600 to a health savings account in 2021. Okay, which is basically 1,000 more than the younger counterparts, those who are age 55 and lower and younger. And one thing I want to say here is that you can no longer contribute to an HSA once you enroll in Medicare. All right, those two are mutually exclusive. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are still having a conversation here about the top 10 tax deductions and credits for people over 50. What are the most popular tax breaks for seniors and retirees? Number 5, taxable Social Security income. So what happens here is that your Social Security benefits might or might not be taxable income. It really depends on your overall earnings and your tax situation. And so, if you add up your income from all sources, including taxable retirement funds other than Social Security and what would normally be tax interest, you would find out if you actually qualify or not. Now, I want you to also add half of what you collected in Social Security benefits during the course of the tax year to that total. And the Social Security Administration should send you at year end Form SSA 1099 around the first day of the new year, showing you exactly how much you received. And I just want to specify here that you don't have to include any of your Social Security as taxable income if the total of all your other income and half your Social Security is less than $25,000 and you are single, head of household, or a qualifying widow or widower. I'm going to repeat that this is very important. You don't have to include any of your Social Security as taxable income if the total of all your other income and half your Social Security is less than $25,000 and you are single, head of household, or a qualifying widow or widower. And this amount increases from 25 grand to 32 grand if you are married and filing a joint return, and drops to zero if you file a separate return after living with your spouse at any point during the tax year. So if you happen to fall outside of those income levels, up to 85% of what you collected in Social Security might be taxable. And we actually have found a pretty cool tool. If you go to the IRS website, we're actually showing this to you right now on the screen. The IRS offers an interactive tool to help you determine if any of your Social Security is taxable, and if so, how much. So we have the link. We put the link down here on the screen so you can see. And this is a tool that will help you determine your status. Number 6, folks. Number 6, small business expenses. So if you are retired or semi-retired and still run your own business, guess what? Deducting business expenses can be a great way to lower your taxes and optimize your return. And this could be anything, whether you're a florist or you're just working as a part-time consultant for your former employer, or doing, having a home-based office. It costs money to operate your business. And what you pay for things like business travel, equipment, and home office utilities can be turned into tax deductions that reduce ultimately your taxable business income and tax burden at the end of the year. So that when you file your Schedule C on Form 1040, you will be reporting a lower income amount. All right. And the cool thing here is that if you've lost money from your business in the prior year, you may be able to deduct that loss for other income, such as retirement income, your local, and this is something that's very important. And now make sure that you check your local state tax laws also. Really depends upon your situation. And if you're not, if tax and accounting and all those things are not your forte, I would strongly suggest to hire a professional accountant, a professional tax accountant. He or she could be a CPA or an EA, an enrolled agent, or even a fiscal attorney to help you figure out your situation optimally. Number 7, we have low income return exemption. And actually, this is not exactly a tax credit or a deduction for seniors, but the low income return exemption can provide a bit of a relief for those in low income households, eliminating a potential source of stress and financial strain for many 65 and older. So for us, it has the same impact, the same consequence as a credit or a deduction. So by law, married couples who meet the age threshold and make under 27,000, not including Social Security, are not required to file a federal income tax return, while seniors with one spouse younger than 65 don't have to file when that total is under $25,700. And single individuals over 65 with an income under $13,850 also qualify for the low income return exemption. So here you have it. Number 8, we have property tax breaks for seniors. And the cool thing here is that property taxes is a local thing, is a state thing, right? So property tax rules vary considerably by state and local jurisdiction. But in some places, people who are above a certain age and who also earn below a specific income level qualify for property or school tax deferrals or exemptions. I'll give you an example. I want to give a shout out to our Texas viewers and listeners. In Texas, for example, homeowners age 65 and older are eligible for a $10,000 homestead exemption for school district taxes, in addition to the $25,000 exemption for all homeowners. And local jurisdictions can provide additional exemptions for seniors. Right, so this is pretty cool. So what you want to do, you want to take a close look at the specific rules to qualify for property tax breaks in your area. And you may need to fill out extra tax forms or an application before you can claim a property tax exemption. But guess what? The earnings, the benefits, the savings might be worth it. So go ahead and check it out. Number 9, additional IRA deduction. So older workers can defer paying income tax or on more money than younger people by contributing to an individual retirement account. So workers age 50 and older can save an additional $1,000 in an IRA for a total of $7,000 in 2020. And so basically what we're having here, what this means is that, for example, a 50-year-old worker in the 24% tax bracket who maxes out his or her IRA will save $1,680 on his or her current tax bill. And this is $240 more than the maximum possible tax break of $1,440 for a younger retirement saver in the same tax bracket, in the same 24% tax bracket. And low and moderate income seniors who contribute to a retirement account may additionally qualify for the Savers Credit. We have covered the Savers Credit on another show, and this is a cool credit also that is available for millions of taxpayers. Number 10, folks, I've been having a convo with you about the top 10 tax deductions and credits for people over 50. So number 10, we have 401k catch-up contributions. So the cool thing here is that Older workers with access to a 401k plan may be eligible to make catch up, something called catch up contributions. So basically, the way it works is that employees age 50 and older can defer paying income tax on 6,500 more than younger workers if they contribute that amount to a 401k plan, or a total of $26,000. And an older worker in the 24% tax bracket, again, I just love the 24% tax bracket. So an older worker in the 24% tax bracket who happens to max out his or her 401k plan could save $6,240 on his or her current tax bill, $1,560 more than a younger worker in the same tax bracket could potentially save. And the cool thing here you have to understand is that income tax will not be due on this money until it is withdrawn from the account. And I also have two more bonus. As a bonus, I have two more what I would call tax deductions and credits that are available to people over 15. You have no more early withdrawal penalty. So younger workers who raid their retirement accounts are hit with the hefty 10% early withdrawal penalty unless the money is used for a couple of specific purposes. However, once you turn age 59 and a half, you can withdraw money from an IRA for any reason without incurring the 10% tax. And if you leave your job at age 55 or later, you can begin penalty-free 401k distributions from the account associated with the job you most recently left at that time. However, income tax will be due on withdrawals from traditional retirement accounts at any age. As a retiree or older citizen or older taxpayer, you still can have access to free tax help. So older people can get help filing their taxes without having to pay an excessive hourly fee. And you have something called the TCE, so the Tax Counseling for the Elderly program provides free tax assistance to those age 60 or older. And the cool thing here is that the program is run by the IRS, so everything is managed by the IRS. So you have IRS certified volunteers who assist older taxpayers with basic tax return preparation and electronic filing between January 1st and April 15th each year. And the cool thing here is that the TCE program specializes in tax issues seniors typically face, including tax questions about pensions and retirement benefits. All right, folks, this is it for today's conversation. I was talking to you about the top 10 tax deductions and credits for people over 50. Number one, you have a larger standard deduction. Number two, charitable deductions. Number three, tax credits for older adults. Number four, medical expenses. Number five, taxable Social Security income. Number six, small business expenses. Number seven, low income return exemption. Number eight, we have a property tax breaks. Number nine, additional IRA deduction. Number 10, 401k catch-up contribution. And I had two more bonus items for you. You have no more early withdrawal penalty when you take money from your IRA. And you can get free tax help through the IRS TCE program or the VITA program. Thank you so much for your attention. Happy filing, and I'll see you next time. But until then, remember, stay marvelous.